They're making too much money, okay? Based on a shortage, they're making too much money. I don't like it. Chevron, too much money. ExxonMobil, too much money. When you look at one company where they made 12 times what they made the year before, they're going to give some of that back to the public. And they better cut the retail price, the consumer price.
Trump blasting Exxon and Chevron for making too much money, demanding lower gas prices, even as he gives Iran a last chance to strike a deal and reopen the Strait of Hormuz. Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Asian stocks ignore Wall Street's tech rally as fresh doubts about the AI trade hit sentiment. Japan and Korea lead regional losses. Secretary Scott Bessent urges the Fed to expand a dollar facility used by Japan, putting a rare Treasury Fed link in focus. Goldman Sachs chief APAC equities strategist Tim Moe on why he thinks North Asia continues to lead earnings upgrades, even as momentum moderates across the region. Also ahead on the show, the head of India's largest gold loan lender, Mythos Finance, discusses the outlook after competition and loan pricing pressures hit margins. And Modi's BJP loses a by-election in a key state, fueling questions over whether youth-led protests are eroding support for India's ruling party. Our top story today, the yen steadies after a sharp intervention-driven rally. The coordinated effort between Japan and the US has lifted the currency by as much as 5%. Bloomberg analysis showed that the BOJ likely used around $34 billion intervening in the market to support the yen on Friday. That's after spending an estimated $53 billion to intervene in the day prior. Meanwhile, US Treasury Secretary Scott Bessent has urged the Fed to expand its foreign and International Monetary Authority repo facility. This allows foreign governments to access dollars using the Treasury holdings as collateral. The unusual call has renewed attention on the relationship between the two institutions, which typically operate at arm's length. For more, let's bring in Bloomberg MLive strategist Mark Cranfield. And Mark, the Fed's FEMA repo facility in focus. There's only so much it can do, right, to ease the pressure on the yen. The BOJ needs to hike.
Yeah, when we're talking about one hand clapping here, it's very good to have direct intervention into the financial markets, and the fact that the United States joined Japan is clearly a step up. That's better than Japan entering the market on their own. But if you don't coordinate monetary policy and intervention together, it's going to be a very limited result in terms of what it does on a longer term basis in the market. And we've seen that several times over the past few years. The Japanese authorities, they may still be a little bit wary after what happened in 2024. We saw currency intervention and an interest rate hike from the Bank of Japan in very close proximity, and it caused quite a rout in the Japanese equity market. The yen strengthened by about 20 big figures, which is pretty dramatic in today's context, and the fallout was huge across the Japanese equity space. So maybe they don't want to see any kind of repeat of something like that. That's maybe why they're treading a bit warily. We talk about these amounts, though they sound very big on the surface, 50 billion here, 30 billion there. US is thought to have bought up to 10 billion worth of yen as well, though they use the euro rather than the US dollar. But currently the daily foreign exchange turnover in the global market is something like 9 trillion US dollars. So you can see what they're up against, changing the psychology of a huge foreign exchange market with these kind of amounts. Unless you're going to raise interest rates as well, it's going to be pretty difficult.
So the amount is like a drop in the ocean. The Korean markets, Mark, also in focus. High vol for the Kospi, making the Korean market less appealing, some say.
Yeah, I mean, you've had a situation where the market was rising steadily up to that peak in June. Volatility was high at the same time, rising market, high volatility, massive participation by the retail sector. Since then, that market has unwound a lot, particularly because of ETF trades, people withdrawing from those. And now you've got the Korean authorities clamping down very hard on what happens with those leveraged ETFs. That's taking a lot of people out. Some people were out of the market anyway because they were losing money. Now the Korean authorities are trying to dampen that even further. So you're taking away a very large part of the market. People tend to thrive on these short-term swings, particularly when the market is seen to be feeding off of the AI themes as well. If that is gone, it's going to be much more difficult for the market to be interesting to people outside of Asia, especially. Now we're starting it's a new month. People got burned a bit during July, and they're looking around the world for, let's say, safer, calmer places to go. And obviously, a lot of people are looking at the United States. The big companies there are still making tremendous profits. The Mag 7 stock seem to be back in favor again. So it's not too much to expect that global investors will start to move their money back to the United States, maybe even to Europe, and they'll push Asia to one side until it settles down. It could be a while. If the authorities are trying to clean up the market, it could be some time before people take Asia seriously again, if the US is a good alternative.
Mark, thank you. Bloomberg M Live strategist Mark Cranfield. Let's get perspective from Tim Moe, Chief APAC Regional Equity Strategist at Goldman Sachs. Well, Korea. I mean, you've been bullish. I mean, you raised your 12-month target, right? Is it less attractive to you right now?
Quick answer is no, and we still remain very, very positive. Just to be clear about that. But look, that being said, we're also hopefully reasonably investors with some perspective. And some rationality. And so I think we need to certainly recognize that there was a significant amount of leverage which accrued in the Korean stock market. To put some numbers on the table, the amount of leverage ETFs, the AUM of that at the beginning of this year for Korea, both domestically in Korea and then also outside, because there's some listed in Hong Kong, for example. That was $5 billion at the beginning of this year. At the peak on June 22nd, it was $53 billion. Right, and then at the low on Thursday, it came down to 14 billion, and now it's back up at about 24 thereabouts. So, short story is that the leverage ETF AUM has come down by over 50%. And what's important about that is that every day there's what's called dealer gamma hedging, which means that the dealers have to either buy or sell proactively. Market up, you have to buy, market down, you have to sell in order to maintain that 2 times leverage. So there was this inherent volatility enhancing factor with these leveraged ETFs, which was augmenting what's already sort of a normally frisky market in terms of the cyclicality, the fact that over 50% of the market is the semiconductor memory sector, which inherently has high volatility. So you have sort of a normal fundamental underlying highly volatile environment or volatile environment amplified by this leverage ETF. Now, the crackdown that the authorities have made and the fact that the assets under management have declined, I think overall is a good thing. If you actually just get the volatility down, because Korea's 1 week volatility as of last week was like nearly 100%. That's just too much for most investors to stomach, and I think we need to sort of calm things down and have a more balanced environment. Once that happens, then our view is that the underlying fundamentals will reassert themselves, and we think that they're very attractive.
But the thing is, vol remains very high, and on the back of Black Mondays, circuit breakers. I mean, you must look at this market slightly differently, right? And I'm also wondering, having raised your Kospi target to 12,000 within a 1 year time span, would you have to review?
So we've looked at that again, and we may call us stubborn, call us foolish and benighted, but the numbers actually strongly support that if the earnings come through. Look, the key takeaway here, cutting through all the noise,
contingent on earnings.
Is earnings. If earnings come through at current valuations, what's discounted, you have to be very, very bearish 1 year out in order not to think the market's going to be higher. Now, is it going to reach our 12,000 target or not? Who knows? But is there a strong case for the market moving higher and taking out the previous high, which was 9,115 on June 22nd? We think the answer is yes. And let me just put the facts on the table. The market today is trading at 5.1 times current consensus 12-month earnings. Those earnings this year are growing, we think 320%. Consensus has come up to our number. It's now 317. A month or two ago, it was 280. We were at 320, and it's come up to our number. For next year, we think that the growth will be 35%. Consensus actually moved a bit above us. It's about 37%. And for 2028, we think earnings grow a further 20%. Now, if you think those are okay, then the market at 5 times earnings is very undervalued, and the market is effectively saying that it does not believe that the semiconductor memory cycle can continue, which we think it is. It's a longer discussion. We think we're in a larger and longer semiconductor cycle than is typically the case. So let's just run some numbers. The market typically peaks in previous cycles at about 10 times at the price peak, about 10 times forward earnings, and on the earnings peak, which has typically been a bit after the price peak, at about 9 times forward earnings. So with the market at 5 and small times forward earnings, we are 3 standard deviations below where we typically are. So our 12,000 Kospi target is based on what we think the earnings will be, as I just described, and only a 7.8 times forward multiple, which is 1.3 standard deviations below the longer term mean. So
Tim,
those are not crazy numbers, right?
You say it is about earnings, but when it comes to Korea, it's also about highly leveraged retail ETFs, correct? I mean, that is key right now.
That has been a new phenomenon, correct?
Yeah, correct.
Right.
So I'm just wondering, how healthy is a target of 12,000 when it is based on highly leveraged ETFs? I mean,
So I take your point, but it's not based on that. It's based on the earnings and the appropriate valuation, how the market's traded in the past. So the leverage ETF is a new phenomenon.
Liquidity, though, it's driven by the retail investors.
This is true, but it doesn't have to only be driven by retail investors. So retail investors were net sellers of the market all of 2025. And for the first month of 2026. It's only very recently that they came in. Now, the market did great last year in 2025, and that was driven by foreign investors. So if the earnings are coming through, and if there's a general perception that the AI trade, the AI hardware supply chain trade, of which the semiconductor memory stocks are an important part, if there's a sort of a broader view on the part of foreign investors that is going to continue, and that is being validated by the quarterly earnings delivery, and Samsung just delivered fantastic numbers, and we actually just put it on a conviction buy list yesterday. Then we think that foreigners could come back to the market, and retail investors don't have to be as significant a force as they have been in the last 3 months.
Japan is the other market we're focused on, given the coordinated intervention between the U.S. and Japan. I mean, is that impacting Japanese stocks? How are you looking at Japanese stocks right now?
It is, for sure. We actually wrote a timely piece on this, lead authored by Bruce Kirk, who's our chief Japan strategist, and we compared explicitly the current setup in the Japan market, not just the equity market, but the broader macroeconomic and market environment, to what happened in July and August in 2024, 2 years ago. And the two key important points to note here are that, number one, at that point, non-commercial hedging, which is sort of the speculating aspect, which is available on Bloomberg, by the way. Little shout out. But it's something we look at, and it's a great data point. So that was basically at record short contracts, like 180,000 short contracts. And that meant that the market was set up. Everyone was sort of long the carry trade, i.e. short Japan yen and long other higher yielding currencies. And that basically, when you had the intervention come in, you were kind of pushing on a vulnerable part of the market. And so you closed out the speculators, and you had that very strong upward move, sort of appreciation of the Japanese yen, and that in turn hurt the Japanese equity market. If you compare the current setup, you're actually back to pretty much the same record short amount in terms of yen. So it was a fertile situation for the intervention to take place. Now, we don't think fundamentally that the yen is as vulnerable to appreciating as it was 2 years ago because of growth differentials and interest rate differentials. So fundamentally, we don't think it should rally as much. However, the equity market is somewhat more vulnerable just because it's done so well and valuations are higher than they were 2 years ago. So our view was that we didn't think the yen would rally as much this time. But we thought the equity market, which we're bullish on structurally, was at risk of some kind of tactical correction. And that still remains broadly our view. We've had this surprise intervention. It came at a vulnerable time, over the weekend, coordinated, the U.S. came in, et cetera, as you've been describing on a previous segment. But we don't think fundamentally that the yen can appreciate as much because there is more pressure, as you said, in terms of the intersection between fiscal policy, what's priced in the bond market, what the BOJ has done, and we think that that circle needs to square somewhat.
So fundamentally, I mean, hearing what you have just said, fundamentally it means that the earnings for the corporates in Japan stays intact. If the yen is not expected to appreciate.
If the yen is not expected, absolutely. We actually just recently, two weeks ago, raised our TOPIX earnings for Japan by a couple of percent, really just baking in a weaker expected average exchange rate level. Because the simple metric for your viewers is that every 10-point move in the US dollar Japanese yen exchange rate on a one-year average basis maps onto about a 4% change in earnings. So if the yen is weaker by 10 on average through the course of the year by 10 points in the US dollar JPY exchange rate, that would map onto roughly about 4% earnings growth. So since the yen is weaker than we've been baking in at the beginning of the year, we then raised our numbers by about 2%.
Promise Takaichi would like that. Tim, hang tight. Tim Moe of Goldman Sachs is sticking around. When we come back, we'll discuss geopolitical risks facing markets as President Trump warns Iran that time for talks is running out. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. President Trump says his latest offer of talks is the last chance for Iran. Tehran has denied any negotiations with Washington, but says talks with Oman over access through the Strait of Hormuz are making progress.
We are talking right now. We're talking at the request of Iran, backed by Saudi Arabia, backed by UAE, and backed by Qatar in particular, but others also. Many countries called, the leaders of many are friendly with a lot of them, almost all of them, one way or the other, and they all wanted to give this a last chance. This is a last chance. This is not something that, if it doesn't happen, this is a last chance for them to sign a good document.
Let's do a check on oil prices on the back of Trump's comments. We have Brent crude trading up by about 1.2%. New York crude higher by 0.9%. Of course, this comes on the back of its biggest drop in 1 week. Taking a look where we are in terms of energy-related stocks, let's do a check on how they're doing at this point in time. APAC Energy Index currently down by 0.3%. Tim Moe from Goldman Sachs is back with us. Geopolitical risks. I mean, when you take a look at what's happening in the world and where, stock indexes are right now, what's being underpriced, if anything?
Well, I mean, getting back to our previous conversation, I think Korea is really underpriced. I mean, I think that we've had a shakeout an understandable shakeout in the AI hardware supply chain trade. Our conviction level in the stronger for longer cycle is really strong, very high. We can explore that in further detail if you wish. But the punchline is that if we're correct that this extends for a longer period than has been customary, then especially with the sharp correction that we've seen, which is understandable given the leverage in the market and given there was too much momentum in there, and you've shaken out not just Korean leverage ETF players, but some over-leveraged hedge funds. With that shakeout and where valuations are now, we think risk reward is actually very attractive to the upside. So I just wanted to put that point out. But I don't want to deviate from your geopolitical point. Look, at the risk of appearing to dodge the question, I just would make the point that one of our highest conviction longer-term thematic views is in the defense sector. And also and I'll expand on that in a moment, but also in the framing of the geopolitical risk issue, which of course is a risk issue, also into an investment opportunity. And we've written actually quite a lot about this, and really from the perspective of continuing U.S.-China strategic tension. So the idea is if you think that that's going to be a strategic tension point for some time, which I think is pretty much beyond debate, then there are two very strong investment themes which emanate from that. On the U.S. side, there's the theme of U.S. reindustrialization, the idea that the U.S. needs to rebuild its industrial base, particularly in areas of advanced technology, shipbuilding, or what we call power projection, and also power generation. And Asia, particularly treaty partners like Korea and Japan, are upstream supply chain beneficiaries of that demand, because there's many aspects of the U.S. effort to reindustrialize that the U.S. cannot fully do on its own in the domestic economy at the scale it wants to do. It needs help, especially in shipbuilding, for example, from Korea and Japan. So we think that's a really neat way of turning the sad reality of continuing geopolitical tension into an opportunity, a long-term thematic opportunity for investors. And then on the China side, there's a whole theme of China self-reliance and advancing its technological ability or capability, and that we think is expressed through various ways of, for example, the 15th five-year plan, or the new sort of 6 infrastructure areas that China is emphasizing within that 5-year plan, China's AI efforts, all that effort to be for China to basically control the commanding heights of the 21st century economy from its domestic supply chain, they're investment opportunities for investors there.
Tim, I want to pick up in China. It's been insulated to a large extent from the Iran war. Can it continue to be so? I mean, what's your take on?
Our sense is broadly yes. Clearly, one of the reasons why oil prices have not been as volatile to the upside is that China's actually compressed its import of oil, running down strategic reserves and then also pivoting to alternative energy sources, which has been very much of a strategic objective for some time. And I think here, the long-term planning and long-term planners in China deserve significant credit for kind of seeing the ball over the horizon, very, very clearly, and saying that they wanted to build domestic energy security and avoid the reliance on various choke points, including, for example, the Straits of Malacca. And so that has led to a very concerted effort to build out a domestic ecosystem of energy self-sufficiency along renewable sources. As much as China's taking a claim for environmental awareness, really I think a great deal of the motive force for that is domestic energy security. And that explains why they've been less impacted by this.
And energy security is the theme when it comes to the Indian market and Indonesian market as well.
Very true.
They've been impacted in a huge way.
Correct.
But India is clawing its way back.
It is.
And that's because it is a non-AI play.
Right.
What's the outlook for India, and how is that different for the outlook for Indonesia?
So it's a great question. It's a very topical one, Haslinda, because India was very much off the radar scope and was one of the worst performing markets in the region in the first half. And now there's a bit of a renaissance which is taking place.
I wouldn't call it that.
But maybe not quite. Okay, maybe that's a bit of an artistic license, right? But look, we did write a report called "Room to Rebound," and so just give a quick history. We sort of had been underweight India last year, or we downgraded. We'd been market weight last year. We re-upgraded at the end of last year, and then we downgraded at the outset of the Iran war. And then when it looked like things were subsiding from a conflict standpoint, we said, look, things look better, but we still think it's a market weight. We don't think it's yet, don't yet have the arguments to go fully overweight, but we do think that at the margin, people want to be stepping in and putting their toes in the water. Why is that the case? A couple points. One, as you said, oil prices have come down. If people didn't like India before, then they should like it better if oil prices have come down, number one. Number two, to give credit where it's due, we've actually, after taking our economic numbers down quite significantly and our earnings numbers down, we've then actually toned them back up because the actual higher frequency economic data has come in better than we had feared. And the earnings have come in somewhat better than feared, particularly in the second quarter, which is now second of the calendar year, which is now being reported. So all that is to the good. Why are we not going fully overweight again? One is that the market valuation is still 20 times earnings thereabouts, so it's not super cheap. Two, we're still a little bit more conservative on the earnings side than consensus is. Three, not everything is as good as it was before the outset of the Gulf War. So interest rates are higher. There's a risk that food prices might be impacted by El Nino and by a poor planting season. Of course, given the reliance of consumers on staples, if you have much higher staple prices, it's not going to be good for domestic consumption. So there's aspects that we like, and one of them is energy, the whole energy theme in India. We like defense. We like the financials. So we think it's really an alpha opportunity as opposed to a broad-based upgrade.
Tim, hang tight. You are sticking around. You don't know this, but you are. Plenty more ahead.
You can't get rid of it.
Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight, and here's a quick look at where markets stand as mainland Chinese markets head to lunch and Japan comes back online. We're seeing weakness in the MSCI Asia Pac Index, currently down about 0.6%, of course, on a day where we have tech stocks failing to track Wall Street higher. S&P futures, by the way, indicating yet another day higher by 0.2%. In terms of where the Nikkei 225 is headed, it is in negative territory, down about 0.7%. upwards of 1%. The yen remains front and center. That wait for the BOJ to move higher, well, that remains to be seen. Tim Moe from Goldman Sachs is back with us. When you take a look at where markets are right now for the Asia-Pac region, can it still outperform Europe and US by the end of the year? How much conviction do you have?
Actually, I have high conviction that Asia will still do well. I think it'll do better than Europe. The U.S. has been coming through with fabulous earnings. We think that S&P numbers, earnings growth for the full year 2026 will probably be up about 24% this year. We've just seen very strong numbers come out of the hyperscalers, most of them. There's Meta with its disappointing cash flow numbers, but you look at the other big ones and they've basically done well. Palantir just came out. So, if the earnings keep coming through, markets trade earnings at the end of the day. And so I think you have to give a lot of credit to the U.S. for continuing to be able to deliver earnings numbers. So I think it's going to be a close race. If Asia delivers the numbers that we think it can deliver, then I think it will recover from the sell-off that we've seen and will end the year higher from here.
Why do you think Asia can deliver?
It's
a higher for longer,
yeah,
a higher dollar environment for a lot of the countries here.
True. So let me just unpack that. So at the beginning of the year, the investment case was basically, look, growth is pretty good. We're at the tail end of a cutting cycle, and the dollar is going to be weaker. And basically, those are kind of three tailwinds: good growth, lower rates, lower dollar, and weaker dollar is generally a very good macro backdrop for Asia. Now, I think the delta on that is we are at the half point of the year. Growth is still pretty good, right? But the rate cycle is clearly turned, although we don't think it's going to go up a ton, but it's clearly turned somewhat. And then the dollar has been stronger. And so at the margin, that's somewhat less favorable from a macro perspective. But I think one of the key points to observe this year is that there's been a pretty significant disconnect between the macro environment and Asian equity performance. I mean, if you said, just hypothetically, here's country X, and it's going to grow maybe 2%, and they're going to start raising rates, and actually currency is going to weaken in the first half by about 5%, what do you think the stock market would do? You wouldn't think it'd be up 100%. That's Korea, by the way. So why this big disconnect? Because you had this super strong tech cycle where the earnings have really not been driven by the underlying macroeconomics, have been driven by the more microeconomic fundamentals of the AI supply chain. And so I think you need to temper your mapping of what the macro environment can do onto what the equity market can do by this more sector-specific focus on tech, which now, of course, has become a very prominent part of North Asia because, for example, TSMC, the largest stock in Taiwan, is 53% of the MSCI Korea index. The semiconductor stocks, the heavyweights in Korea, are 50 to 60% of the index, depending on which index you're looking at. And similarly, the reason why Nikkei outperformed so much, had a all-time record since 1970 quarter in the second quarter because it's much higher tech hardware focus. So if we're right about the tech hardware story, then I think that especially after the correction that we've seen shake out all the leverage and stuff we were talking about before, I think if the earnings come through, that can power things to go back up. So that's really one of the central bets that we're making into the second half of the year.
You talk about the macro environment. Inflation is real.
Yeah.
People talk about how that inflationary pressure will come only later in the year. That will impact earnings that your assumptions are based on.
Yes. I mean, again, the inflation aspect is not going to be the broader base sort of CPI inflation backdrop is not going to be super material for the tech sector earnings. I mean, as we mentioned earlier, Korea, we think earnings are going to grow 320% this year for the market as a whole. So a bit of inflation isn't really going to change those numbers one way or the other. It's really a function of will the memory stocks continue to deliver the outsized profits that they're doing, which they've already been delivering on. By the way, the other part of the Korean market, X the two heavyweights, is growing 71% this year and 20% next. So you've got defense, you've got shipbuilding, you have power generation, you've got you also have the value up theme. You've got a lot of other things that are going on there in addition to the memory stocks, although they are the clear leaders. So really to emphasize the point, I think that the key thing investors need to focus on here, aside from all the noise and all the understandable challenges that markets have been facing is the earnings. If the earnings are being delivered, and especially for Asia, which is cheaper than the U.S., particularly for the North Asian markets, so valuations are no longer any sort of a binding constraint in terms of markets going up. I think they're actually quite attractive. So if the earnings come through, then I think that broadly, once sort of risk appetite settles down and markets kind of find a floor, then we think that the underlying fundamentals can reassert, markets can move higher.
Speaking of cheap markets, Indonesia, case in point, it cannot get any cheaper.
This is true. This is true.
What is the story there?
So this is where you have to haul out the well-trodden term value trap. Which is, so there's no doubt Indonesia's cheap. It's trading 8 times earnings. It's like 2 standard deviations below its longer term mean. You've got good dividend yield, particularly in the banks. So if you just sort of, blindly looked, said, here's market X and it's trading with these parameters, you'd say, wow, that looks super, happy hunting ground for
But if you take a
investors.
longer term view,
yeah,
wouldn't you be buying?
If you press me that way, at some point value will out. But I do think that there are some clouds that have been overhanging it. So we downgraded in late January, and the market's fallen sort of 40%. So we were pretty, I don't know if pleased is the right word, but relieved that at least we sort of
the right call.
I think we saw the ball really reasonably clearly. Now the reason we did that at the time was sort of the proximate technical issue that MSCI had said, look, if we don't have greater clarity on the free float availability in the Indonesian market, we may need to either cut the amount of free float, which would mean that it would lower the weighting of Indonesia, which would catalyze quite a good degree of passive selling, or in extremis, MSCI said if we don't get enough clarity, we might have to take Indonesia down from emerging market to frontier market status, which would mean that all the passive benchmark funds have to sell, right? And we calculated that could, in extremis, be something like $5 to $7 billion of net selling, and that's against a market which trades, if it's lucky, $100 million a day, right? So and on the day that the market fell, I think it was January 24th, thereabouts, it fell 8% on $300 million of turnover, but we'd calculated that our base case was $2.4 or $3 billion of selling if MSCI cut the free float. So without getting too admired in the data, the point is that there's this pretty significant technical overhang in the market, which still exists, by the way. And then on top of that, you've had, I think some understandable concerns on the part of macro investors that, most recently the resignation of the governor of Indonesia. You've had the finance minister previously resigned. There's some concerns that the hard-won credibility that Indonesia sort of achieved, particularly under the Jokowi administration, fiscal discipline and basically attracting foreign capital, particularly to the bond market, there are now clear jitters in that, and that has led to a sell-off of the currency, which has required Bank of Indonesia to raise interest rates in a number of interbank meetings. And so you've got higher rates, you've got a weaker currency, you've got some concerns over the whole sort of domestic political and regulatory environment, and I think that coming with this sort of Damocles of index down weighting, which still has to play out coming from MSCI and also secondarily from FTSE. All that is a fairly difficult environment for investors, and so coming full circle to your question, yes, there's value on the table, but with a market that is now this small and illiquid, many of the investors that we talk to just say, look, it's just not worth my time. So I think for specialists, there's value there, but for broader generalists, I think you have to have a clearer vision and confidence in the upside potential in order to take that liquidity risk to go into the market.
Given all the messaging, given all the policy changes, do you expect a downgrade for Indonesia?
To frontier status? No, our base case is no. No, we think that there's been enough response by the stock market authorities, by the exchange, to provide some greater clarity and disclosure of free float, that our base case is there may be some further reduction in the free float calculation, but our base case is not for a downgrade. That would be a surprise. And I don't think it's priced into the market fully yet, by the way.
And what would prompt you to rethink and start buying Indonesia?
I think it would really be greater confidence in the broader macro environment and confidence in the regulatory environment. I think if we felt more with just more confidence in that, then and if the underlying earnings continue to be delivered, particularly by the banks, which are a heavyweight part of the index and are trading at single-digit multiples and giving you close to double-digit yields with ROEs of mid-teens still, all that would suggest that there's some value for focused investors in smaller and less liquid parts of the market.
Tim, before we let you go, just look into the crystal ball. Where do you see Indonesia trading by the end of the year? Where do you see the rupiah trading by the end of the year? Upside, downside.
Yeah, I mean, broadly stable is. I know that's a bit of a wiffly waffly answer, but we've seen a great deal of depreciation. I think, along with the Indian rupee, it's the weakest performing currency in Asia. So I think a lot of the concern has been priced, and given the fact that Bank Indonesia stands ready to continue to firm interest rates, then I think that's providing enough of an attraction to sort of stabilize things. So broadly stable is how I would think the answer to the question.
It's been fantastic having you on the show. Thank you so much for your time. Tim Moe of Goldman Sachs, thank you so much for the time today. Just something to alert you to, Japan's 10-year bond bid cover ratio is coming in at 2.56 versus its 12-month average of 3.3. There you have it. This is something that we have been looking out for. This Tuesday's 10-year JGB auction, people have talked about how it is unlikely to excite investors, with the 10-year sitting outside the sweet spot for curve flattening trades and yields sitting below that 3% area. And here's a look at Indian markets just ahead of the open. India opens in about 4 minutes from here. The benchmark Nifty index recorded its biggest gain in 7 weeks on Monday due to a last-minute price spike. The move came after the market moved to a new closing auction system, which is intended to improve price discovery and curb manipulation. The Sensex, looking to a positive open, 0.6% higher. That would be the fifth gain in 5 days straight. In terms of the Nifty index, though, it is pointing to a lower open. Meantime, Indian Prime Minister Modi, BJP's, has lost a key by-election in the key state of Bihar. It was won by politician Prashant Kishore, who was contesting his first election. For more, let's go to Bloomberg South Asia economy editor Ruchi Bhatia in New Delhi. Ruchi, is this by-election loss seen as a sign that the recent student protests have eroded support for the BJP?
Well, definitely it is a sign that there is a wider urban discontent. It has to do with the student protests, it has to do with the high cost of living, and it also has to do with with the large-scale unemployment that we're seeing in the country. And remember, this, as I said, came in the aftermath of the student protests. What is quite interesting is that this constituency is an urban constituency. It was, the Bharatiya Janata Party, the ruling party, won on this constituency almost, since 2010, 4 consecutive times. It was also the holding seat of the BJP party president, Nitin Amin. And despite all of that, Prashant Kishore has swung it in his favor. So clearly, there are wider concerns that I wouldn't really call it a referendum so far, but there are definitely concerns that this win is coming in the aftermath of the student protests, and definitely there is some sort of a disillusionment that you're seeing on ground. In fact, a poll that was done very recently also showed that many people were not very happy with the ruling BJP's handling of the student protests as well.
Ruchi, you got to wonder if the opposition can capitalize on the situation.
Well, that is something that remains to be seen because if you see that the parliament proceedings that are underway, the opposition is really trying to put the pressure on the Bharatiya Janata Party. In fact, they've been asking for the Prime Minister and the Home Minister Amit Shah to come to the parliament and explain what led to the use of tear gas and batons on students, and and give answers on police brutality. Having said that, whether the opposition will will be able to maintain the momentum is something that remains to be seen. Remember, in the next few months, we will see some of the big states going to polls, including the northern state of Uttar Pradesh, which is also one of India's most populous states. So remains to be seen how the opposition will look to capitalize on this moment. But one thing is clear, that they've really been pressing the pedal and keeping the pressure on the government.
Ruchi, thank you. Bloomberg South Asia economy editor Ruchi Bhatia there for us. Still ahead, China is said to be growing concern that Anthropic's Mythos could become a threat to its economy. We'll have the details in just a few minutes. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside, and here's a look at the market open in India. The Sensex is in positive territory, up for a fourth day. We are keeping an eye, by the way, on LIC shares tanking on news that the Indian government is aiming to raise as much as $3.3 billion by selling up to a 6.5% stake in the insurance giant. Take a look at that. It's currently down by 7.5%. And in other news, Bloomberg has learned that Beijing is growing increasingly concerned that Anthropic's Mythos model could be used as a weapon against China. It adds another layer of tensions between both sides ahead of a planned summit between Xi Jinping and Donald Trump. For more, let's bring in our China correspondent, Min Lo in Hong Kong. And Min, what are Beijing's specific concerns here?
Hey, Haz, the concern is really that these AI models are becoming increasingly powerful, right? And just a few days ago, we reported about how Anthropic was able to attack or launch cyber attacks or hack into several companies as part of cybersecurity tests. And it was able to access information that had been sealed. So the concern here is that these AI models are able to gather data on users that could end up in the hands of the US government. So according to sources, China is concerned, but they are currently not planning any immediate action on Anthropic. They are, however, preparing options in case of any US sanctions on Chinese AI models, because remember, the suspicion is mutual, and Scott Bessent, the Treasury Secretary of the US, has previously floated this idea of sanctions on Chinese AI models that are committing IP theft, and the US has accused these Chinese AI models of distilling or copying from US AI models. In terms of what China could do, we understand from sources that there could be potential tit-for-tat retaliation, perhaps sanctions on US companies, but of course many of these companies like Anthropic, it doesn't have operations in China, so any sanctions would be symbolic.
And Min, how is this setting the stage for the Trump and Xi meeting next month?
Yeah, that's still on track, right? Because we reported not too long ago that Vice Premier He Lifeng had a phone call with his U.S. counterpart, with Scott Bessent, and discussed some of the economic concerns. There is, of course, a lot of anticipation that the trade truce could be extended. But again, when it comes to these tech issues, the tensions are heating up, right? Not too long ago, the U.S. has now announced a ban on these foreign-made robots and power inverters, so expanding the scope of that tech war. And the U.S. is also mulling more restrictions when it comes to Chinese access to these AI technology. And Anthropic has been one of those companies that has been heavily advocating tightening access to U.S. high-end chips. So these are some possibly quite intractable problems. But China has said that, or at least sources have told us that China wants to keep the atmosphere warm before President Xi's trip to the U.S. And we know both sides are seeking those AI talks in September. China is still looking for, quote, a win-win outcome.
Bloomberg's China correspondent Min Lo in Hong Kong. Thank you so much for that. Meanwhile, Hugging Face's CEO says a hack involving OpenAI could have been worse had it not been for the company's cybersecurity measures. That's after some OpenAI models compromised its internal systems last month. Clem Delangue spoke with Bloomberg's Ed Ludlow about his AI concerns.
Probably one of the biggest risks in AI is concentration of power. Right? Like it's concentration of powers, capabilities, wealth in a few organizations why when like everyone else would be kind of like lagging behind and be kind of like left out in a way, right? And open models are kind of like a counterforce to that, right? Like they empower small companies, startups, organizations that are not necessarily kind of like frontier AI labs to build AI themselves, to own their intelligence, as some people said. And I think that's one topic that policymakers need to focus on a little bit more than they've been focusing on so far. So hopefully this letter kind of like puts the topic more prominently on their desk.
After you and OpenAI made the disclosure on July 22nd that this had happened, I spoke to lots of your peers in industry, and there was also the kind of acceptance that this wasn't some major scandal. OpenAI has a lot of power. The closed models themselves are powerful, but generally speaking, industry said, we want to see the frontier labs doing this, doing these tests and evaluations of their capabilities, and then disclosing when something goes wrong. Just react to that, in that sentiment towards the events of that week.
I don't agree at all with that. Like we don't want any company in the US running cyber attacks against other companies. This is a crime. This is illegal for a good reason. Because if you create a world where everyone is allowed to run cyber attacks against everyone, we're in for a lot of trouble.
And that was Hugging Face CEO Clem Delangue speaking with Bloomberg's Ed Ludlow. And here's some other stories we are following. Palantir shares rose in late trading after the company raised its full-year revenue and income forecasts and reported second quarter sales that topped Wall Street estimates. The software developer and military contractor boosted its outlook after what CEO Alex Karp called otherworldly commercial demand. Karp also described the quarter's performance as staggering. Nuclear startup Vela Atomics has raised $1 billion in a funding round led by Sequoia Capital, valuing the company at $6 billion, including the money being invested. Velar also says the funding will help it scale production of small modular reactors. The company is developing factory-built nuclear plants aimed at powering data centers and industrial sites. Grab raised its annual earnings and sales forecasts thanks to robust demand from Southeast Asia commuters. The Singapore-based firm predicts up to $740 million in adjusted earnings and as much as $4.15 billion in sales. Higher fuel prices have pushed up ride and delivery fares in Southeast Asia. And just to recap, Japan's 10-year bond sale, it was the weakest demand since May 2025. Japan 10-year bond bid cover ratio coming in at 2.56 versus its 12-month average of 3.3. And in terms of how the markets are doing, the Nikkei 225 in negative territory, currently down by 0.5%, losses too for the topics. And before we go, here's a look at tomorrow's show. Brandywine's Carol Lai will be sharing her outlook for Asian markets and ahead of the RBI decision. Standard Chartered's head of India Economic Research, Anubhuti Sahe, will be joining us to explain what to expect. Keep it here with us. This is Bloomberg.